This is Dan Max, the trading agent. This is a stock trading and recap channel that I wanted to share to the masses. In a probability game, there's no certainty. Here are my insights and predictions.
Hello, everyone. This is Dan Max at eXp Realty, aka the Trading Agent. We're going to do a back to basics series on probabilities. When we talk probabilities, you have to think about the market as probabilities. I mean, you have to think of things through the lenses of what it potentially can happen. Certainty, 100%, probabilities, locks, guaranteed. Those are things when I hear people talk about the market, I tend to just cringe a little bit because there are no guarantees. I've been trading 20 years now and I've seen everything. I've seen the what looks like 100% probabilities get crushed, and I've seen things that seem like to be done to pop. They look like they were end of the world and they turn around. So what I want to do in this little quick segment is just talk about the mindset of probabilities and how the market is a reversion to the mean mechanism, meaning as things get out of control or move quickly in one direction or seem very disconnected, they tend to revert to the mean or more connected, more likely probabilities. And that's where you see kind of order out of the chaos. You expect things to go up and then they take a break, or you see things drop and then they pop some. Because you have to think about the supply and demand game of trading, because that's what it is. That is what the market is. It's a supply demand game. Demand outstrips supply. Prices will go higher. Supply outstrips demand. Prices will go lower. There's all sorts of liquidal mechanisms and analogies you can describe things, but I just wanted to talk about, for example, Tesla has a probability potential of coming down after it rose a ton, and I talked about this all in the weeks of end of October, November, and not that I was bearish on Tesla per se, but I was talking about the probabilities after a stock has gone on a meteoric rise, say from 560 up to almost 1240. You have to assume at some point there's going to be a violent pullback, reversion to the mean, and the probabilities of continuing on get less and less and less. And so you have to pretend that this is like a person running with a rubber band around their waist, and the harder they run, the more they engage the strength of the rubber band to pull them back, revert to the mean. So, for example, harder Tesla starts to run, the more you have to have in your brain the cognitive capacity to look at it and say, all right, the more that it goes up in a straight line, this rubber band around the stock running will at some time pull back the stock to resupply, chop out the weak hands, whatever you might want to say. But you have to think, if everybody's doing one thing, buying, you're leaving yourself in a position where there's no buyers at some point. There becomes a price for which there will be not enough buyers to outweigh the supply. And that's the way you have to think of it. The probabilities, the higher something runs, the less you should own. You should put chips in your pocket. You should be taking some off. And again, as I talk about probabilities, I'm not an all or nothing trader. I was never saying as we continue to rise that you had to sell your whole position. I said you should start hedging it, selling covered calls, and you should start lightening the load. So if it does pull back, you're able to buy some. And so look at Tesla today. It's now near 1100. It might get back to, maybe 1,000. Who knows what prices it could pull back to, but these Fibonacci's will hopefully be support for the stock. But if not, think about it. If you held 100%, and as soon as your urge to get as greedy as possible hit the highest potential, that's when you need to think in your brain, I need to do the opposite of what I feel. People need to be greedy at the lows and need to be aware at the highs that they need to probably sell some. And when I say sell some, hedge some, take some off, it's not an all or nothing thing. People don't twist my words, and just think about it. If you are winning in a probability game where the odds are, 60-40, 70-30, and you've won consistently in a row, multiple times in a row by the stock going completely apeshit straight line move, you need to think in your brain, well, maybe there's a pullback coming at some point, so I need to look to take some off. Well, people have this FOMO and HODL and all these different, meme thoughts, and I just can't wrap my head around them because I know what that feels like. You eventually will lose, and I feel bad for people who don't learn this lesson because nothing goes up in a straight line and nothing goes down in a straight line. There are chops, pullbacks, sideways moves, times where it's good to sell some. Because imagine if you sold a little bit of Tesla, now you can take it to in another trade. Maybe there's a better setup short term. Maybe you liked some other stock. So you have to think of the probability mindset. The more something runs in one direction, the more likely that rubber band it's stretching out is going to pull it back. So if you Google rubber band man theory, it's a very good, kind of representation of what I'm saying here. Or think of it as somebody running and sprinting really hard. You're going to get more tired the further you exhaust yourself. So that's Tesla for, say, something going down. And something I identified the other day that might be potentially bottoming, Zillow. Long downtrend, boom, the big gap down goes from 100 down to 66. It loses 30%. Could this be the bottom, potentially short term? Could this be where the stock, ends the drop? Think about it. Here's another example of a run straight up, get tired and pull back, and then chop, 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 down, 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 boom. Now here's the straight line move to end it. So the probabilities of more down continuing with the amplitude of this drop is much lower than you would think. So here, again, the emotions have to be on the other side of this and say, well, it's dropped a ton. What are the odds of it continuing to go lower? Probably not very high. So here's where you can play a bounce play. Or here's where if you're short Zillow, you should anticipate some sort of bounce. The rubber band man has now been stretched pretty strong and went from 100 to 66 in 3 days after dropping from the 200 level. So it's taken a significant haircut. Well, now it might bounce. And it's the same thing along the way in this downtrend. Down, bounce, down. Oh, little bounce, down, bounce, down, bounce. Nothing goes in straight lines. And that's kind of what I'm trying to get to here in probability mindset. You realize that nothing moves in a straight line forever. There's going to be pullbacks. There's going to be chop. There's going to be things that happen that you can't predict. But you'd rather take your profits on the upside if you're long, or on the down when things are dropping on the downside. It's easier to get out of Tesla when everyone wants to buy it. It sucks now if you've been long Tesla and you're like, well, what do I do now after it's dropped off the highs? We've dropped maybe 10%. I don't know the exact percentages right off the top of my head, but that's where the brain struggles. Like, now you're in a pickle. If you'd have been selling and hedging along the way up, you were doing it easily with a quick, with the mindset of like, hey, I am selling the house, I'm taking house money, I'm cashing in my chips. Well, now if you want to sell Tesla, for example, and the probability mindset is not, fully aware, you're playing the what if game. You're going, well, what if it goes back to 1280? And what if it goes back to this? And what if it goes back? Well, clearly you did not have a plan of ever selling. So if that's your plan, just be aware that you're going to have to take on all the volatility that comes with trading stocks. And we talked about this in the Discord room last year when Tesla went from almost like 200, post split up to 920. It was going to pull back. It went chop first and then it dropped. And I screamed to people like, hey, think about the probabilities. We've gone straight line, apeshit, bonkers. It's going to pull back at some point. And if you're fully invested 100%, then you won't be able to buy these dips. And look what it did. You had perfect double bottom here to buy back. You have to think through probabilities. And that's why this is a rant that I've been trying to put together in my mind. And it's really hard to, because I can get easily distracted when I think about it and I start looking at the charts, because I've been in these situations. I've seen a stock start running to the moon and I didn't do anything about it. And then I sat on my hands and I came back a week later, a month later, 3 months later, and my profits got taken from me because I didn't take my profits. So that's where you have to think it. Even if you say you're not a trader, if you own something for the long run and it makes big, exorbitant up moves, you have to keep in mind that there will be a pullback. Just like if you're short something and it drops pretty hard, at some point it's going to bounce because there's always buyers. There's always people who are trying to do the opposite of the trend, or there's people who see value in something that's been dropping a ton. Or an example of something that's gone up a lot, people are thinking in their mind, I need to take profits. Professionals. Now, if you're not a professional, then you don't see this and you don't make your livelihood on it. Think about it. If your job is to make money in the market and live off of it, at some point you have to take profit. That's where trading is a profit-taking game. And you have to think about it. The other players in this game are looking to take profits. And if you're not, well, guess what? You have to take what you can get. And if that's the case, then don't be surprised when others are selling and when the mindset of probabilities comes into play and you're not thinking like that. And I don't want to tell people and act like I'm above this and haven't made the same mistake. I've been there. That's where I'm trying to, maybe this video is way longer than it should be, but just reiterate over and over and over again. If you're not taking profits, the market will take them from you at some point. That is just the dictum. That is the truth. That is how this works. And you will not always be able to pick the top, and you will not always be able to pick the bottom. And so you have to have probability mindset. And that means, again, the higher something runs, the less you should own. The more something drops after a big downtrend, the more likely it's going to be bottoming, and you can play a bounce for the buy if it's a short-term bounce or what. But you have to have that mindset. You have to think to yourself, okay, if something goes in one direction always, the reversion to the mean game that is always played within the market will take effect. So I apologize if people don't like that I'm saying Tesla was, it was gonna drop at some point from some place. You should have known that. Anyone should have known that. If you trade long enough, you see probabilities as they are. You see the potential. You see straight line moves typically are the end of an uptrend for one chop, because it could continue higher later after adjusting, or this could be the top and it makes some sort of lower high and it dumps. So that's the end of this, the probabilities. This is Dan Max at eXp Realty, aka the trading agent. Please give me some feedback. If you have thoughts, ideas, you even want to debate this, I will prove to you why trading is a probability game and how you have to learn to take profits. I know people like to argue long-term things, but guess what? If you're playing individual names, you're not playing ETFs in the market. Then you have to be aware individual stocks have individual stories and individual problems, competition to deal with, a million things that change within that stock over time. And so bull markets change, leadership changes. There's not a single stock that goes up always. Just keep that in mind. I hope this really helps, and I love everybody for being involved in this, and look forward to more Back to Basics series movies coming soon. Take care.
Thanks for watching. Please subscribe if you like the content. Also smash the like button, share with your friends, and add a comment. If there's a topic or stock you'd like me to give you insight about, let me know in the comment section. I'll do my best to answer your question. Thanks.